How to invest in gold in the UK in 2026. Gold busted through $4,000 an ounce for the first time ever in late 2025 as records were falling everywhere and people raced to buy it amidst a cocktail of geopolitical tensions, trade disputes, wars, inflation, and more. But why? What is it about gold that appeals when the world wobbles? I mean, what do people see in a metal from the dawn of time when we are living in the era of AI, crypto, and algorithmic trading? What's this all about? Is it a cracking investment, or should I be investing too in gold in 2026? Well, hi, I'm Gary and I'm here with Moneyfarm to unpack this and understand what's happening with gold and whether it stacks up as an investment opportunity. So, why the gold rush? Why, when financial markets are experiencing shockwaves and people go scurrying in search of a safer place to put their money, do so many choose gold? Well, gold doesn't tend to behave like other assets, such as shares and bonds. When markets come under stress, it can hold its value, even when other assets are plummeting. Because of this, many investors take comfort in gold during times of global instability and turbulence. They view it as a safe haven, and as they flock towards it, prices can surge. And none of this is new. For centuries, people all over the world have turned to gold to store their wealth, from the coins used in the ancient kingdom of Lydia to the treasures of Roman emperors to Egyptian artifacts to lavish wedding dowries around the world. And it's not just individuals, it's governments too. Enter the vaults of a central bank and you may come across a pile of gold bars. At last count, the Bank of England had 400,000 stashed in the basement of Threadneedle Street in the City of London, second only to the reserves held by the Fed in New York. But what makes gold so special? But why gold in particular? What is it about this metal that has such enduring appeal? There are several reasons. The first one is that there's only so much gold in the world. It's a rare material, but also not so rare that no one can get their hands on any. Two, it also doesn't decompose or go rusty, and it's fairly easy to divide up and share by melting down and making bars, coins, or other items. 3. And you can't use it up like oil or crops, as almost every ounce of gold that's ever been mined still exists today. And it's because of these qualities that gold, historically, has been at the center of the financial world. So much so that governments created the gold standard in the early 1800s. The idea was simple. Each country's money was tied to the gold it held in reserve. So, in theory, every banknote in circulation could be exchanged for a fixed amount of gold, in so helping currencies in gaining credibility and stability. Britain was the first to adopt the gold standard in the early 1800s, but before long, most of the world's major economies followed. The gold standard lasted right up until 1971, when President Nixon finally severed the link between the US dollar and gold. Since then, the world has operated on fiat currencies like the dollar, the pound, the euro, or the yen. And under this system, a country's money is no longer tied to gold, but instead, its value depends on factors such as a government's credibility and market forces. Governments adopted this system to help manage their supply of money, something we saw a lot of during the global financial crisis. But as we already know, most governments do still hold gold reserves today, and they do this as a hedge against inflation and currency risk. So gold is perceived as a safe haven by many investors, but what impact does this actually have on prices during times of strife? Well, There are plenty of instances. For example, during the global financial crisis, as banks failed and markets crashed, gold prices surged, passing $1,000 an ounce for the first time in 2009. And a decade later, when the world shut down during the COVID pandemic, it broke records again, this time breaching $2,000 an ounce. And more recently, breaking the $4,000 an ounce amid the economic and geopolitical uncertainty driven by inflation, the war in Ukraine, the war in Gaza, and the tariffs introduced by the Trump administration. And all this is leading to bumper numbers. According to World Gold Council figures, a record-breaking $64 billion was plowed into gold ETFs during the first 9 months of 2025. And it's not just investors like us buying gold, but governments are too. Since 2022, central banks have been snapping up over 1,000 tons annually, more than twice the pace of the previous decade, helping driving the price up since 2022 as they diversified their reserves away from the US dollar. But apart from all this, what are the pros and cons of investing in gold? So, what are the pros and cons of investing in gold? Let's break it down. On the pro side, 1, as I've talked about at length, gold can hold its value when markets are volatile, which is where its safe haven reputation comes from. But do remember that it's an investment, so there's always the possibility that you could lose money. 2, it can be a hedge against inflation and currency risk. Historically, it's maintained its purchasing power when cash has struggled, as its fortunes are not tied to a single currency. 3, gold can provide helpful diversification in an investment portfolio because it doesn't typically follow the ups and downs of shares or bonds, as it's largely, as they say in the investment world, uncorrelated. 4, in certain circumstances, gold comes with tax benefits for UK investors. Coins made by the Royal Mint, such as sovereigns, are exempt from capital gains tax because they're considered legal tender. And the cons? Well, if you're looking for an income from your investments, gold doesn't pay dividends or interest, as returns are only dependent on the price going up. 2, its price can be highly volatile and hard to predict because it's heavily influenced by global events, central policy, and investor sentiment. 3, and also when you buy physical gold, you have to think about where to store it and how to insure it. But all this considered, should I invest in gold in 2026? Gold certainly has an important role to play in investment portfolios. As we've seen, it can help diversify your portfolio, which can help reduce investment risk. But how much you should include in your portfolio is down to your risk tolerance and depends on a number of factors. That said, usually, investors holding it as a hedge often allocate between 5% and 10% of their portfolio to gold. But how do you actually invest in gold in 2026? The number one way is to invest in physical gold. This is where you buy an actual piece of gold, usually in the form of a bar or coin. The problem with this is that you also need to insure it and find somewhere safe to keep it, which will add to the costs. And clearly, you can't add a bar of gold to your ISA or SIP. Your second option are ETCs, or exchange traded commodities. These are investment funds that track gold prices, so you can invest in gold without the hassle of owning it. The good thing about ETCs is that they are easy to buy and sell. There are no worries about storing or insuring gold, and you can even add most ETCs to an ISA or SIP. The third option is to invest in gold mining companies rather than gold, which you can do through shares or funds. This way, you get exposure to the gold industry, but you're not investing in gold itself. You can hold these investments in ISAs or SIPs, but they're less reliable as a portfolio diversifier and can be volatile. And just so you know, both option 2 and 3 are things you can easily do on Moneyfarm. So there you have it, the shiny facts and figures on gold. If you like this video, please subscribe to the channel and check the description for more information about Moneyfarm and how to get started investing today.